present this paper here. When I saw the advertisement for the Ben Graham value seminar, I thought, gee, I actually have a paper I think that fits ideally to this. Not, and all of them do, but I thought this one did because here we are talking about what Ben Graham did, trying to find good investments by doing a lot of work and seeing what what on one hand is a fair risk pricing, and on the other hand, find what you can do to find mispriced stocks. And so here we are, sort of at a point where we have a lot of anomalies that have been built up over time, and gee, just as soon as I got used to and try to incorporate this accruals anomaly, now this the NOAA anomaly, I have to think about it. And I don't know if I'll go that far. I think I will, though. That's pretty interesting. If it relates to this, which gets kind of going. But anyway, I thought it was among the different things. We have all these anomalies, and the explanations for anomalies fall into one of two categories: either market efficiency, that the anomaly really is a manifestation of some rational risk-return trade-off, or behavioral finance, that the anomaly is due to something about investors' psychological biases. And so it is important to document anomalies, and it's certainly important to find out whether they are anomalies or actually manifestations of efficient markets. But in the meantime, I think it's also important to determine just whether all these different anomalies are independent of one another, whether they can, or maybe they're manifestations of each other. So that's what I tried to do, especially as I started thinking that not all of many, about 6 of them down here, maybe more, sure are candidates for relating to each other, in a sense, if you think about it. And that's my case. My proposition is that the following anomalies are related. They're linked. Specifically, as I've been able to propose here, a model via a relationship involving operating profit, not just profit, but it's cash profit, and external financing. So the anomalies are the external financing anomaly, where we find that future stock returns are negatively related to prior external financing activity. Both debt and equity. Now it's been documented that the stock price rises up to the point of issuance, but disappointing performance afterwards. The external financing anomaly. Then the failure risk anomaly. Several papers now have shown that stock returns are negatively rather than positively related to failure risk by measuring that several different ways, which is really flying in the face of Fama and French right away, because there's 2 factors there are supposed to be distress factors. And so if we don't otherwise independently find that distress itself, or probability of failure itself, is priced in the right way, then we have trouble interpreting factor 2 and 3 of Fama French 3-factor model. The raw profitability anomaly, where future stock returns are positively, actually rather than negatively, related to recent raw profitability, simple earnings or cash profits, whatever. Turns out that it should be easy to show that if a company made money last year, they have a lower probability of failing in the future. They're less risky. And if they lost money, they have a high probability of failing. And so the company that lost money last year is more likely to, or should have a higher expected return, a risk premium of sorts. And yet they don't have higher returns. And there's nothing simpler than that. Did they make money? Yes, good investment. No, not a good investment, in a sense. Raw profitability, not adjusted by anything. Post-earnings announcement drift, we all know. Earnings announcements closely related there in terms of that there's a drift in returns. These are related to, you can imagine, raw profitability anomaly relating to the post-announcement drift anomaly. Right? What's it? One by one or pairwise, you start piecing them together in your mind. The question is, can you put them all together? Book-to-market anomaly, is book-to-market a measure of risk or mispricing? Is a huge debate at this point. We have evidence on that. And then in red here to show the accruals anomaly. I've got that in, I got that out. That's the sixth factor. It's really on the fence in terms of, I got evidence that it's, first of all, it's an anomaly. Some have found that stock returns are negatively related to accounting accruals, but gee, I find that, but I find that it's also negatively related to default risks. So I don't know if there is a mispricing there at all. So I don't want to emphasize that last one. But anyway, so I have developed this schematic in the sense of what I'm trying to get at to help, I guess initially myself, to see all these relationships that go on. Now, I'm going to actually split that into rational part and the mispricing part here. Only figure one is in there. But we think about some basics here. We're going to be looking at a firm's profit, last year's operating profit, and also in the output sort of is their short-term or long-term returns in the future. But in the meantime, we're also going to say, well, what do you think about return last year, return in the previous year? What's the relationship, all of this, with risk, our major measure of risk? The only measure of risk I'm looking at is failure probability, 1 year or 5 year failure probability. Then sort of at the center here really is a total external financing, where we know we have an anomaly going there. And of course then book to market. And it turns out that through, I mean, you can trace some rational pricing relationships. R plus is a rational positive relationship. If you did well with your earnings last year, you should have a positive return probably last year. But if you had profits last year, then probably failure risk is lower, those kind of things. Let me get to the rational quickly and simply to the rational one first. For example, if you had profit last year, that's going to reduce your probability of failure. And okay, then separately, if you have some measure of your probability of failure, the higher that is, the higher you should have future returns. Okay, so there should be, therefore, a negative relationship between profit last year and returns in the future, but there isn't. Okay, and then you go in this profit and return last year, that should have lowered the book to market. And there should be a positive relationship risk-wise if we are believing a story. This is the story this is the rational story for book to market. Book to market, if you lost money, your book to market's going to end up lower, and it's because you're going to get repriced for higher failure risk and have higher expected returns. So there it is, the risk story relating to book to market. But mispricing-wise, we have a whole different story going. It turns out we got a large part of this is a hype story. So a firm last year, this is all going on last year. Last year, a firm is going to lose money, have negative operating money. They're generally then going to do more external financing, literally cover the operating loss with stock financing or debt financing. Meanwhile, in preparation for doing that, they and or the investment bank are going to hype up the stock. So the returns last year will be good, even though they lost money. The stock gets hyped up. This firm has a high failure risk, but it's hyped up, had big external financing, and it's going to be a disappointing investment in the future. So hyped up money-losing firms doing external financing are poor investments, big time, in the empirics of it. And that's a big part of this, and it flows through book to market too as a mispricing thing, because hyped up stock has low book to market. Low book to market is not, you know, the really strong firms, you know, the low discount rate, all stuff. There's some really terrible low book to market firms that are money losing, hyped up stocks that did external financing and they have higher failure risk as well. So that's what we end up uncovering is in terms of trying to, we're able to see the relationship among many of these anomalies. So one assumption is that, that right now, at least we're assuming, working with the simple notion that expected return on a premium on any stock is just related to failure risk and nothing else. We don't have an asset pricing model really going in there. We hope that people say, yeah, well, you know, Fama and French is based on that too, in a sense, and only on that. So, yeah. And data, U.S. incorporated non-financial, non-utility firms that have seasoned enough to trade for at least a year, from 1980 to 2001, because we need an extra 5 years then also to trace their returns throughout the 5 years. We're going to add a year now, but pretty soon. Methodology, we create 274 equally weighted portfolios by either single sorts. All of this is done by quintiles, except for one that's just at 4 instead of 5 categories. But basically think quintiles on either size, a book to market, profit or leverage, or any of 3 external financing variables, net debt, net equity, or total external financing. Pairwise combinations of those, okay? So if you match, so you form a portfolio of small firms that did external financing, and we create a total of 274 portfolios each year that are combination, just to get a bunch of portfolios basically, but really to spread in all these different directions of all these different variables, okay? Just a technique, we think that, you know, let's get it all spread out there and kind of see if we can then work with these portfolios and see how they behave. And we have standard assumption there. So the timeline is, accounting-wise, we have the last year's profit and external financing. We have the firm's size, book to market, and leverage. And we look at their last year's return. RET 6 month is a kind of a gap period between the end of the fiscal year and the kind of standard 6 month. We can actually start the portfolio. We look at that gap period instead of ignore it, though. It's interesting to look at that gap period. I call it gap period, maybe GAAP period. But anyway, but mostly, obviously, the 1 year and then out 2 to 5 years on returns and failure rates to see. So also we have a little kind of thing, prediction, if things are going to be attenuated. If there's anything going on, mispricing or rational risk pricing, it's likely that there will be larger effects will be in the short term, and then it'll get kind of medium sized and small the further you go into the future. Okay, so this is a little view of say, we got the size effect here, quintiles of size, and yeah, the past returns. Future returns, smaller firms have larger returns. Get the size effect, got the book to market effect in terms of high book to market has much higher returns. It's so robust in this world, you always find that. But we don't find that the failure risk is higher for higher book to market, short term or long term. A bit there, but it's not, you know, quite as powerful. Even size works as far as failure risk of small firms is 100 times bigger than large firms, okay, in terms of failure risk. So we start to already see something wrong about book to market as a risk factor. And then, you know, profit too. Higher profit firms have higher returns, not lower returns in the future. And they do have much lower failure risk. So we got an anomaly there. Individual leverage is kind of flat all the way around. Net debt, net equity are both, well, actually net equity suggests a hyping, because even though they lost money, these stocks have high returns last year, and then they are destined to have low returns in the future. Debt issuers are not so hyped up. They're not so much money losers either, but they don't have good returns going forward. So there's a little difference there, but in some respect we can kind of combine this if we want to. Total external financing is somewhat of a story of hyped up money losers that then are destined to have lousy returns. Table 2 have these kinds of tables just to give you some detailish look at what we're trying to do with these portfolios, that kind of crossing dimensions. Here are size against book to market. Well, that's your classic. Okay, what do we have? Both size and book to market work in terms of returns, shorter term and longer term returns. But one thing that's interesting is on the failure risk, as you higher, there's not this good relationship, proper relationship on book to market for it to be a risk factor here. And then profit and leverage. Let's get the size and total external financing. Show a lot of different combination things. You want to look at, once you have the different combinations, you want to say, well, what's a failure risk? What's a return last year? What's a average returns this year? Is this a risk factor? How are they interacting? You've got hype going on. That's what we're doing in the paper, basically. And then we've got a grand correlation matrix based on those 274 portfolios, which you can look yourself. But then from this point forward, we want to see if we really have a goal to see if we can forecast failure, whether the candidate factors, risk proxies, do forecast failure, and then if there is a positive relationship somehow, somewhere, in some dimension between risk and failure risk and returns. And then otherwise, looking for return reversals too from the previous year to the future, because you could have a rational return reversal. Firm had lost money, they priced down, they should have a higher expected return. So reversals should be seen that can be rational, or there could be mispricing reversals. So you want to look at that as well. And so table 13 here shows some simple regressions. This is a 5-year failure risk on each individual risk proxy as well as the financing variables. And we see that overwhelmingly size is the most powerful forecaster of failure. Okay, but then profit is also that. The others are all weak. There's nothing else. All you need to forecast 5-year failure rate for firms is size and profit, basically. With size and profit together, which form in a stepwise regression, they would be the first two chosen, and they explain 87% of the variation in the dummy variable failed or didn't fail in 5 years. So we have a handle on factors that determine failure, or the risk in our analysis. Okay, so then we look and see if what's going on in terms of return last year. What determined return last year? Well, for example, profit was pretty important. If you had more profit, you had generally have higher returns last year. Book to market is negative related. You get to have a low, high book to market by having losses last year. We kind of know that. Size, positive, and so on. Then, but in terms of future returns, we have what works is table 14. We have total external financing is important, and there's a negative relationship between external financing and future returns. And let me just get to the bottom line here, because I know we're about out of time. Got two extra analyses that we do. We thought of doing factor analysis because we have a lot of portfolios, and we throw them into a factor analysis and see what comes out. It's pretty amazing, actually, that you boil that all down in factor analysis, and generally you could get two factors. That is, and the factor analysis doesn't even want a third one, generally. Sometimes yes, sometimes no, but the whole variance-covariance matrix of all these 274 portfolios over the years boiled down to two factors. And actually, it was amazing, too, that they're readable in terms of that one's a mispricing factor, and that one is a rational factor. You can see it just in terms of the fact that, I'm sorry, it wasn't just the returns, it was all of this, the associated characteristic values that go in here too. So we started with just throwing at the kitchen sink everything in there, and got a separate factor, which is referred to my notes one. You can either explain failure risk, or you can explain returns. Not any combination of them when you get started. But if you start eliminating some, you get down to a final version of factor analysis, which variables to include in the factor analysis. It turns out you can separate into factors. One is clearly a rational factor, higher failure risk and higher returns. And another factor is a mispricing factor. So that's kind of fun. Then we did some two-stage least squares regression, where first stage, actually shown on the right here, is you try to work with a model of forecasting failure, and then that's brought in as fail 5 estimate. Put that in and see if it works. Well, if the only variable used, for example, to get started is size, then that's powerful, and it does come over, and its representation in terms of failure is positive, but the R-square is kind of weak here. But if you want example of rational pricing, it's right there. Size does it all. The smaller firms have a higher probability of failure, and they have higher returns. But it doesn't explain much variation. So otherwise, though, you've worked with other things, and you've got to do some adjusting. There's a problem with profit, as we know. But if you adjust for that, then you can maintain that. Finally, we get down to a final model. It has several important variables. Really, size, book to market, profit, and leverage are thrown in to forecast failure. And then that works as long as, finally, you adjust for total external financing. Total external financing comes the last and kind of ultimate anomaly driver in that sense. That's for that you get some good risk-return activity.
So this is for all non-financial firms, right? All this paper. Is there a way to apply part of this at least to financial firms? Because you would think that a lot of variables that you talked about, they would be important for financial firms too, right?
I'm sure a lot, yeah. It's just such a different world. What do you do about leverage?
Yeah,
is one thing.
Yeah.
I mean, but they're real. It is a shame we throw out banks all the time.
I know.
And even a shame we throw out the utilities because they're major, But no, I think maybe we ought to take lines into research and do just banks and just utilities, by the way. Whatever adjustments are necessary for that analysis.
The timing of the portfolio formation is after the financing announcement or before?
Right. Well, from the end of the fiscal year, we're looking back to see about did they have financing? Did they have operating profit or loss? So then you say, well, what about the future returns? Well, we had the 6-month gap period from end of fiscal year to June, end of June. That's, if you wanted to see what's going on in the returns in that period, that's Ret 6M. Okay, then your standard, you know, what people do, the year ahead return. So, yeah, it's last year's external finance. Something you could look at, doing financial analysis after the end of the year and sort of firms. Great, thank you.
Thank you very much, Ogden.